Okay, this is Chapter 21, Capital Budgeting and Cost Analysis, Part 2. Now we finished what we reviewed, looking at the net present value and internal rate of return method, and now we'll look at payback, discounted payback, and the accrual accounting rate of return. Okay, and then a few other issues, and we're good with the background here, but again, you want to do a lot of problems to make sure you understand it. So the payback method measures the time it'll take to recoup future cash flows from the initial investment. Okay, unlike the NPV and internal rate of return, the payback method does not distinguish among the source of cash flows. Okay, it doesn't matter. It highlights liquidity, which is a factor that plays a role in capital budgeting decisions, and that is really a really important point. Particularly when investments are large, that managers prefer projects with a shorter payback, okay, projects that are more liquid because of just risk that comes with the future, and there's just the fact that things change. So organizations choose an acceptable project payback period. Generally, the greater the risk, the shorter the payback period should be. And shorter ones are preferred because managers are, less confident about cash flows that stretch into the future. And it's really easy to understand, but it fails to recognize the time value of money, and it doesn't consider cash flow beyond the payback point. All right, but as soon as it's payback, that's all it looks at, which can cause it to deliver an opposite result from net present value and lead to a project with high short-run cash flows being selected. Now with uniform, we've got two different types of problems that you'll see in here too. Some where the cash flows are all the same, like in the example that we have where they pay $15,000 a year, or they save $15,000 a year, or it could be different. They would differ period by period until the initial investment is recovered. So we'll have to approach these in two different ways, but it's still relatively simple. Okay, in the payback period is the net initial investment, okay, the initial investment divided by uniform increase in annual future cash flows. Okay, so let's take a look. We'll take a look. I would stop here and go do a payback problem and then come back and finish up this presentation, okay? Now the next method here is the accrual accounting rate of return, and this divides average annual, accrual accounting income of a project by a measure of the investment in it. And the measure of the investment can differ by company, okay? So it depends on, it just depends on the company and how they do it. The other thing is that you'll find it differently. Actually, you'll find it different in different textbooks even, okay? And this is called the accounting rate of return. It's similar to the investment rate of return in that both calculate a rate of return percentage, but AARR is generally regarded as a better measure. So the accrual accounting rate of return is the increase in expected average after-tax operating income divided by the net initial investment, okay? Increase in expected average after-tax operating income. So what's going to happen here is that depreciation is going to turn into an issue, okay? So this is the formula that's used. Remember that the value used for the denominator can vary. So be sure you understand how the AARR is defined in each individual situation. And the formula for accrual accounting rate of return is to take the increase in expected average annual after-tax operating income divided by the initial net investment, or whatever measure they have in there. Okay? Firms vary in how they calculate it. It's easy to understand because it uses numbers reported in the financial statements. It does not track cash flows, and it ignores the time value of money. So, say that when I used to do this, we would do maybe 3 different methods of looking at a project. And when different methods give you different rankings, net present value is going to be the one that everybody chooses. Okay, that's the one that they'll give the most weight to. Okay, because it's most consistent with making decisions that maximize a company's value. Now, one of the biggest challenges in capital budgeting, especially in discounted cash flow, is determining which cash flows are relevant and making an investment selection. You think it would be easy, but it's not. Relevant cash flows are the differences. Okay, the things that would change your mind. Okay, they're differences in expected future cash flows. So a capital investment project has for sure the initial net investment. It has after-tax cash flow from operations, and then usually there is an after-tax cash flow from disposal of the asset and recovery of working capital. So this initial net investment could use purchasing the asset, and it could also include an investment in accounts receivable or in inventory, okay, in working capital. All right? And then when the project is over, that working capital comes back in, but it comes in at a discounted rate. Oh boy, we're never going to see this, but we'll go through this in a problem. These are relevant after-tax cash flows. Oh dear, let's see. I forgot this was here. So here we've got operating cash flows from the investment in a bus are $220,000, and we've got an annual depreciation deduction of $120,000. Okay, so that decreases, it results in a net increase in operating income of $100,000. So we've got to take that $100,000 then, all right, hit it times the 40% tax rate and get an increase in net income of $60,000. Okay, so this is one way to do it. So we've got well, there's two ways that you can do it here. Okay, just depends on how you want to deal with the tax. All right, so 220 is the cash inflow, depreciation deduction, increase in operating income of 100,000. The taxes are going to be 40% times the 100,000 because we're going to take the depreciation out, and the net increase in net income is $60,000. Okay, here's another way of looking at it here. This is called the item by item method, and this is we take the effect of the cash operating cash flows. The operating cash inflows from the investment are 220, and then we're going to deduct the income tax cash flow at 40%. So we'll take 40% of 220 gives us 88,000. The after-tax cash flow from operations is 132. Okay, now we do the effect of the depreciation separately. So we've got an additional depreciation deduction of 120, all right, and this is called the depreciation tax shield, 40% times 120 or 48,000. So the cash flow from operations, net of income, is $180,000. Okay? I think this is the same example that's in the textbook. Now remember, we said that the relevant cash flows are the initial net investment, the initial working capital investment, and then after-tax cash flow from current disposal of an old machine. Okay? Two components of cash flow from operations include the annual after-tax cash flow from operations, excluding depreciation, and then the income tax cash savings from annual depreciation deductions. Okay, and for economic policy reasons, tax laws specify which depreciation methods and lives are permitted. When there's a legal choice, take the depreciation sooner rather than later because that increases the net present value. Plus, that's generally what a company would do unless they've got a big net operating loss to eat up. This will mean more, though, when we start to do problems. I think it's just so you know this is here. For terminal disposal of the investment, we've got two components of it. After-tax cash flow from terminal disposal, Okay, so it would be after-tax cash flow and the after-tax cash flow from the recovery of working capital. So if we liquidate the receivables and inventory that was needed to support the project, okay, that's also like a liquidation value. So we've looked so far at ways to identify relevant cash flows and techniques for analyzing them. The final stage of capital budgeting begins with implementing the decision and managing the project, and this includes management control of the investment activity itself as well as the project as a whole. Okay, so a post-investment audit provides managers with feedback about the performance of a project so they can compare the actual results to the costs and benefits expected at the time the project was selected. And suppose that actual results are less than expected, managers have to determine if this occurred because the original estimates were wrong, or did we have implementation problems, or maybe some of the assumptions of what we thought was going to happen in the future didn't pan out. Okay, interest rates in particular can have a really big impact on this, and who knows what's going to happen with those. So companies should perform post-investment audits with thought and care, only after the outcomes are fully known. But what usually happens, what happens frequently is that you've already moved on to the next project or next problem. So ideally, a manager would be evaluated on a project-by-project basis, only frequently it's done in an aggregate fashion. A post-investment audit may prevent managers from overstating expected cash flows. Okay, that's actually the most important reason to have the audit, is because when someone goes to estimate one again, they're going to think about this audit coming up in the future, and they're going to tamp down their expectations. At least they won't overstate it as much as they usually do. Okay, and finally, there's an inconsistency between using net present value as the best for capital budgeting decisions and then using a different method to evaluate performance. So even though NPV is the best to make capital budgeting decisions, managers would be tempted to make decisions based on the method on which they'll be evaluated, which makes perfect sense because this is all tied into bonuses and executive compensation. Some strategic considerations: that a company's strategic goals are the source of its strategic capital budgeting decisions, and managers can use the framework described in the chapter for project evaluation and also to make strategic decisions about what customers to invest in. So some firms think of R&D projects as important strategic investments. However, the distant payoffs from R&D investments are much more uncertain than other investments, such as new equipment purchases, which is kind of sad because there's a lot of creativity in here. These are projects that might move a company forward a lot, but there's simply increased risk. Okay, and everything in a corporation is about the present value of future cash flows. Everything is. That's what a stock price reflects. That's just it. And for any strategic capital budgeting decision, managers must use good judgment and intuition to make a good decision. You've got to know your business, have a good idea about what's happening in the economy. Have a lot of different information to help inform your decision. Okay.